Hello, everyone. Welcome to Ask the Planman. Everything you want to know about insurance, finance, and more, but we're afraid to ask. I'm your host, Bruce Weinstein, and I have a belief that every one of us should have some sense of a plan, whether it's a financial plan, a retirement plan, a business plan, a fitness plan, a travel plan, even an insurance plan. Each week, we bring you different topics to help you maximize your areas of planning. Today, I'm excited to have us joined by Texas's own Joe Kampert, Vice President of Sales for the Redwood Agency Group. Joe has been in the insurance industry for 9 years, right out of diapers. In 2018, he and his father, David, launched the Redwood Agency Group. They now have over 70 producers nationwide and premium revenue in the 8 figures. Joe believes in helping insurance agents pursue their dreams and want to help every agent build a business that will impact not only their families, but themselves as well. Joe, welcome to Ask the Planman. Tell me, how did you get involved with insurance at such a young age?
Wow. Well, one, thank you, Bruce. Appreciate you having me on. Hopefully going to drop some value that everybody can resonate with here today. And really how I got in the industry was, one, my father had been in insurance right out of college back in the 90s. And so it kind of started there. I am the guy that gets to raise my hand at the event saying I have wanted to be in insurance since I was in second grade. Literally to the point of having a little career fair stand, and I was like an insurance agent. Everybody else was like an astronaut or an NBA player. And I was the insurance agent because that's what my dad did. So I always wanted to be like Pops growing up. And kind of, as you kind of go, you're going through the motions, going through high school, all that good stuff. And really how I got kicked off was I needed, it's funny, and I think a lot of our listeners probably can relate to this, was, hey, you go to high school, you go to college, you get your degree and you get a good job, right? That's just what I was supposed to do. Right. And what's funny is in between my sophomore and junior year of college, I went to Hanover College. It was a private liberal arts school up in Southern Indiana. I was actually playing Division III lacrosse there is how I ended up there. And in order to get into this business scholars program that made my degree look better, I had to get a summer internship. With that being said, Pops had a short stint away from insurance and then had come back. He's always been corporate. I've always been on the agency side. So he got me an interview with an agent in St. Louis, Missouri. Her name is Tracy Bibb with Allstate Insurance Company. And I just went.
What's up, Tracy?
Yep. Shout out Tracy. And I credit her a lot in my upbringing and got an internship. And when I say an internship, y'all, we had just bought, an older book of business, and it was all paper. So my job for the summer was basically I was scanning in paper, and then I was taking like increased calls and claims. So I couldn't talk coverage or anything like that because I wasn't licensed yet. So I was just doing really any of the grunt work there within the office. And it turns out at the end of the summer, she offered me a full-time job. So I actually started in customer service. A lot of people don't know that. And I did my first really almost 2 years in insurance. I was in customer service. So increased calls, claims. Hey, why is my policy going up? And I know we're going to get into that just as far as all the numbers behind that. But if you can do that, you can be a master salesman, right? If you know everything, anybody can actually sell a policy, but do you know what actually is happening on the back ends, right? After you click the button. And so again, I attribute a lot of my sales success, a lot of my management success, because you're managing a book of business, right? But then if you can talk to people when they're like that towards you, I mean, the selling is the easy part. So, yeah, long story short, that is how I got in.
So I neglected to mention. So Joe and his dad are in the property and casualty space. Yep. So this is a P&C, auto, home, commercial conversation today. Yep. So I failed to mention that the Redwood Agency. So if those who aren't seeing Joe on camera, Joe's a tiny person. He's about 7'3". How tall are you?
6'6".
You're like 6'6", yep. And Dad's 6'8".
Dad's 6'8".
Dad's 6'8", yep. And they have at least Dad has more red hair. So redwood for the big redwood trees, and you see our promo canvas we're putting out there with the redwood. So you walk in a room with these guys, and you need to step on a stool to get a hug. So
we do all of our interviews.
They're big boys. Yeah. So they're in a low stool. So the Redwood Agency is a property and casualty agency and what some people might refer to as an aggregator. Correct. They have access to carriers nationwide. They bring on agents and they support them. And so they get them contracts with all the major players in the property and casualty space. So for the average listener, my average consumer out there, the Progressive, the maybe not Liberty Mutual, but the Safeco side,
Nationwide,
Transamerica, Travelers, Nationwide. So those are independents. If you mentioned your friend Tracy at Allstate. So Allstate, Farmer, State Farm, we would view those as captive, right? And so Joe's not captive. His agency's not captive. They're independent. Just like Weinstein Wealth Insurance Solutions, we're independent. We're not working for any one insurance company. And so on the property and casualty side, Joe represents a lot of companies and helps agents build out their own books of business. So I failed to set that particular piece up. So you mentioned getting started in the customer service, and I'm thinking back to the old days. I used to do the remote control, not that it was a close, but in conversation. Now, people like to learn in different ways. And so I'm a driver, expressive driver. So I don't need to know how the remote works in electrical engineering standpoint. I just want to know if I hit the button that it's going to go on. Right. And so what I'm hearing you describe in the customer service world is you were learning the business from the remote control outwards, where most people only learn the sales side. They don't necessarily know how all the mechanics work. So can you elaborate any more on that? Like how did the customer service experience like really amplify your understanding? Was it like a crash course?
I think, it goes back, I just said it, but anybody can sell a policy, but can you keep it, right? And so anybody that's maybe not as in tune with what the whole kind of property and casualty space is, we're not making a ton up front, right? So the revenue it's not like you're getting rich overnight. It is a long haul play. Right. So ultimately, again, you can always replace policies. Right. And I think, again, I think a lot of people get stuck in that cycle. Whereas for us, it was we call it service and purpose. Right. Like once we sell that policy, the goal is we need that policy to stick on the books. We need that residual income. And that's the whole point really behind the property and casualty side of things. And, obviously, we are starting to get into the life and health space now. We're doing some group health stuff as well as just life. Trying to branch out into those different avenues as well. But predominantly property and casualty. But for me, it was, I credit so much to that service side of it because I knew how to keep a policy on the books. I knew how to talk to somebody when they're calling me and like, why is my policy increasing by 30% when I haven't had any claims? Well, it's like, there's a lot of reasons as to why, right? And again, maybe we get into those numbers, maybe we don't. But it's, and the sad part is, it's like, your neighbors kind of suck. Like you don't, but a lot of property and casualty and rates are all based off of zip code, right? And I mean, whoever these actuaries are, I don't ever want to be that where they're going in and they're plugging and chugging numbers and really finding out. And it's based off of profitability within a zip code. And even knowing that, how does that affect your approach when you're selling something? Right? Where it's like, hey, the whole goal is for it to stick on the books. So maybe you take less up front, but in more profitable areas so that your retention and your persistency is higher. Right? So that was, again, that's why I credit so much to the customer service, because if you can't service the book, I mean, great. New business commission, awesome. But you're talking 15% new business commission. Now, obviously that can be lower, it can be higher, right? We've got some that pay higher, some that pay lower. But the whole goal is you want that to stick. And if you don't know how to service a book, and why do a lot of people get into insurance?
Turn it over.
Oh man, like that upfront money, right? That upfront capital, man, I can sell. But then if you get stuck in the replacement cycle, ultimately you'll burn more cash replacing than you ever would actually retaining the policy.
Sure, cost your money. So let's talk a little bit about what you said. The state of, I want to get into, basically for the listener, I want to cover two areas with Joe: is the state of affairs with the insurance space right now when it comes to auto and home. And then I want to get into a deeper dive on commercial and what that entails. But you said something about your neighbors stink, right? And so just the other day, I saw a post on Facebook. You and I pick up a lot of opportunities through the Facebook groups out there. And somebody's like, well, I'm looking for auto and who do you use? And, who should I go with? And everybody's chiming in. And this one's saying that, and this one's saying this one, and talk to so-and-so. And all I responded was, it doesn't matter what anybody else is doing. Your rates are based on you. They're based on you. Your life insurance is based on you. What people fail to understand in insurance is you're the risk.
Right.
When you want to bellyache about what the insurance company's charging you, it's only relative to what kind of risk you're presenting
Correct.
to them.
Yep.
So where you live, the frequency of speeding tickets you get, the amount of speed over the speed limit on those speeding tickets, the amount of accidents, the amount of claims.
Mm-hmm.
Now, in regards to having a clean record, I could see why people would be frustrated, as you mentioned. But again, if your area is all of a sudden impacted with a high amount of claims, or I live in Florida, Joe's in Texas, well, we're in hurricane areas. Yep. Joe's not in a hurricane risk area. So his premiums are going to be a lot less than mine because I'm subject to these mass storms of destruction like Ian just happened.
Right.
So let's, kind of lay that out for people and give them an understanding. It's like, yeah, you have a right to be unhappy. Nobody likes to see their rates go up 30%. But again, tied into the benefit of being independent is you and I can have other options for somebody. If the farmer's agent rate went up 40%, or, oh, by the way, they don't want to cover you anymore, you got to leave farmers, right? You got to go find somebody else. Yep. So at least we can shop it as an independent agent. You could get multiple options.
Correct.
I quoted somebody this week. His daughter needed coverage, and he was a little impatient on the turnaround time, and I understood he had a deadline, but he also probably waited way too long. And he said, well, I just called Progressive. And I said, well, we have Progressive. And I got him a quote later that day in Florida, and it was twice the price of what he got from Progressive Direct.
Yep.
And of course, I noticed it right away. And I'm like, well, send me what is in your quote, because certainly based on price, something's not matching up, right? Yep. If I'm 1,200 and he's 600, like, well, why are we twice? Right. So then finally today, a week later, he sends
even
me
though he needed
coverage.
It yesterday, right?
Right. Well, he signed up direct, and so be it. It's you and I don't retire on one deal. Right. It's not going to make or break our retirement plans. So, and again, it's a friend. You want to help them out. We do other business with them in the health and life space. So, it's nice they came to us. So when I finally got to see it and I'm comparing it, well, now I'm pinging them back of like, she doesn't have this, she doesn't have this, she doesn't have this, she doesn't have this. So that's why the premiums are so radically different on what I showed you versus what you purchased. And so again, it's a cliche, apples to apples, it's not always the same. And if you're shopping price, well, she didn't have rental coverage. She doesn't have uninsured motorists. She doesn't have the same deductibles. Right. They have higher deductibles. Well, higher deductible is going to keep your premium.
Right.
So again, as you're saying, is it all goes into those factors, and all you and I can do as an agent is educate our client to understand the differences, because there's price and there's cost.
Well, and I think, with especially I love that you said that, because we get that a lot. It's like, hey, I just went to Progressive Direct and they beat the price. Now, here's something to know. Geico does it as well. I know that Progressive does it. It's not every time. It's weird. They put in their fine in the fine print. So technically, if you go direct or if you buy a policy online, whatever that means, and Bruce, you know this, I'll try to not go too into the weeds of what these are. But technically, when you go direct, they have up to 60 days to run final reports that actually lock in the rate that you're purchasing the policy at. So say said customer goes to Progressive Direct, maybe even if coverages are matched up and for some reason Progressive Direct is lower. Well, it turns out that they hadn't run the motor vehicle report yet, right? Or they hadn't run the CLUE, which CLUE is basically any of your claim history, your loss history, your actual like property damage of the vehicle, right? Motor vehicle reports, your speeding tickets, violations. The CLUE is basically the accident.
Your DUIs.
Yeah, that's right. Hopefully you don't have one of those. And your accident history. Well, they have up to 60 days to run those reports. So that's why a lot of the times, if you actually go look at the reviews, I've been with them for not even 2 months and my rate tripled. It's like, well, they finally ran the reports. But now here's what they do. They do that to get them in the door, right? So they have that business. And I think, but in that situation
sounds like bait and switch.
Exactly. And I think that's where the benefit of the agent comes in, right? Where a lot of property and casualty agents complain about how we're so commoditized and the consumer only cares about price. I love it, right? Is, hey, you know what? I know that you don't agree with it. I know that it doesn't make sense. It does stink that your neighbors got into a bunch of accidents and you didn't, and you somehow have to pay for it, right? Or if there was a bunch of hail claims or storms, in your neighborhood, but you didn't get a new roof, but everybody else did, right? I actually really like the commoditization piece because that's where I get to separate myself. Hey, we are all selling the same products for the most part. You're going to have some regional carriers in there
Right.
that, they kind of niche down and sell what they want to sell. But for the most part, we are selling the same product. So then why Joe? It's like, well, hey, because we do pride ourselves on customer service. One of the easiest ones is, especially if anybody's, again, direct right now, every time you call in, one, you're on hold for at least an hour, right? Don't even give me, that's just calling to like maybe make a vehicle change, not even the claims department, right? But you're calling in, you're on hold forever, and then you're talking to a new person every single time. So it's almost like you have to retell your story, retell the reason why you're calling every single time, when it's like, or you could just, call my cell phone or shoot me a text and we've got a whole service department that can give you a ring. So, I think there's definitely some things in that. And I know there's going to be your one-offs. There just is, right? And I think that's the beautiful thing, about writing all over the country. And like, so you said, it's not even a state thing. My rates in Houston and Dallas are 1,000 times different than in Austin. So a lot of people, I think they assume the state as a whole. Like Florida, there are parts of Florida that are going to be cheaper because they're not in that hurricane path.
Right. They're
Historically,
landlocked.
correct, right? Same with Texas. It's like, hey, the further north, and then really, and this is kind of more for agents, if you are listening to this as an agent, I encourage you to look at non-resident states because, as we know, Bruce, Florida's really hot. Texas is really hot.
True.
Oklahoma's really hot. Like all these high losses states. Well, then, hey, we get to go right up in the Midwest where maybe the premiums are lower, but they're more stable. There's not much happening in Indiana. It's a bunch of corn and farmland, and it's like, no, the population's growing. You're going to have your claims, but it's not near what Texas or somebody like Florida is. So.
Oh, sorry, to cut you off. So you take like Arizona as an example, and some of the states. When you remove the natural disasters, wildfires, mudslides, hurricanes, tornadoes, the states that don't have that, earthquakes, your premiums are way, way less, which of course, if you're paid on a commission basis of the sale, it's lower commissions on lower volume, but it's easier and people aren't as unhappy. You come into Hurricane Alley here and people are paying $50,000 for their $1 million homes. And they're like, well, why would I bother? But before we go deeper, I want to go back to what you said. And I got to remember what you said. You talked about pulling the motor vehicle reports. So here's a great example. I'm working with your guy, Austin, over there. One of our clients is in Oklahoma, and we're working with you on that case. And so, again, some terminology for the listeners. The so what's I always try to put out here is, so when I got the initial quotes, it was a soft quote.
Correct.
And then when we finalized, he ran the motor vehicles. He ran the MVR. And it firmed up the price, and the price did change a little bit. And I had explained to the client. Now, what does this mean to the listener? Well, a soft quote, just like when you go to the car dealer to get a car loan, you don't want 15 dings on your credit reports. So your auto dealers, we did a show on, leasing and financing, they're going to run a soft credit before they run your hard credit. The soft credit is kind of a 10,000-foot view without hitting your TRW, without hitting your credit scores, right? So folks, you got to understand it's the same thing here. If Joe's running your MVR, they're looking at bankruptcies, they're looking at driving history, they're looking at all of your background. And so they do it soft because people are shopping and maybe they're going to talk to State Farm and Allstate and Farmers. They don't want 6 dings, right? So I want people to understand that that's a component here and that will influence the price once you're ready to move into that. So it happened here. It was about a 10% difference. And I had explained to the client what had happened and why. And it didn't stop her from moving forward. But
if you have an agent or if you're shopping your quotes right now, ask them when they provide you the quote, hey, have you run Clue and MVR on this? You'll blow their mind. Because the agent, well, now here's the other thing. And this is why the direct carriers, that 1-800 you can buy online, on our side of it costs us money every single time we run that motor vehicle report and we don't sell the policy. Now, what's the biggest determining factor of whether that rate stays the same or not? It's running that report. So, hey, I want to buy it. Let's run the motor vehicle report. It doubles. I don't want it anymore. Well, then I just ate that cost of the motor vehicle, which is why the directs wait. They want you to sign up and buy that policy, and then it doesn't actually cost them to run that motor vehicle report. That all runs through LexisNexis. massive
Right.
data hub, and that's nightmare. Don't even get me started on LexisNexis, but it's a really good point. And I think, I wanted to touch real quick because you said like Arizona, right? Where it's less commissionable dollars, right? But really, even if you look at a volume play, right, it actually makes more sense you can just go capture more business in that market versus trying to take everything in said hot state like Texas or Florida. But I think it goes back to my customer service mindset, where it's easier to retain that policy. So why wouldn't I want to write more of those, right? And so it's funny that I just kind of went there in my head. I'm like, oh, well, that's probably because of my customer service experience where, hey, it's not as much. But if the whole goal is for it to stick as long as possible, then I want more of those. And then you can kind of use your higher premium states to kind of supplement. Again, that's on the agent side.
If you take the Arizona Phoenix market and the average deal is 1,200, and I take where I am now in South Florida, Boca Del Rey, and it's 12,000, it's 10 to 1, but that $12,000 person is going to be shopping every hour because they're gagging on 12,000, and then they're going to go to the FEMA back programs. They're going to take a subservient insurance plan. I mean, we just beg people not to go into them, but they're strictly looking at price, and they don't realize till it's too late. Well, what do you mean I'm only getting 20 cents on the dollar? Well, you didn't have a properly backed financial. People have to understand insurance companies are pools of money that is based upon the risk exposure. And so rates are going to go up and down based upon history, based upon forecasts. So if we haven't had a massive hurricane in Florida in multiple years, well, it's coming. Right? There's only so many years in a row before another storm's going to hit. And so we saw this uptick, and we're going to tie this into the state of the union of insurance, is we saw a lot of massive rate increases heading into Ian. Hurricane Ian hit here a couple weeks ago in South Florida. This is late October we're recording. So not that we want to timestamp, but September, the storm came through and it's pretty heavy damage on the west coast of Florida. Well, all year long, we had 7 carriers drop out of the Florida market. We had massive rate increases. We got people being told we're dropping you. We have people that won't be covered because the roof is over a certain age. And they're all throwing up in their mouths. And they're like, what am I going to do? And we're giving them $18,000 quotes and $15,000 quotes. And then some clients like, well, I don't have a mortgage. I can self-insure. Yeah. Okay. Hope you got $1 million lying around in case your house gets wiped out. Right. So insurance is mitigating risk. If your biggest asset is your home, you have to protect that asset. And unless you're willing to write a check for that to replace it, or you have another home to go move into and walk away from it. Give me one more here on this one, because I just learned this the other day, and I don't know if I've shared it for my listeners. So I had another gentleman, and his carrier dropped him in Florida a couple months ago, and I gave him new quotes, and he's like, well, that's too expensive. And he delayed so long. He had a mortgage.
Moratorium.
So the mortgage company turned around and said, well, we got coverage and we put you into this. And he says, well, and he gave me the price. He goes, well, they got it for a lot less than your quote. And he deemed that to be acceptable and happy. Well, what he doesn't know, and here's another so what punch in the face for everybody, the mortgage company is only obligated to take out enough insurance to cover the note, not the full value of the house. And I called him back and said, you better find out how much insurance they have on your property. So if you have $1 million home with a $600,000 mortgage, they're only covering the $600,000. You're on the hook for the $400,000. Your actual equity is not insured. And they don't care. So yeah, it's 40% cheaper, but you got 40% less insurance, knucklehead. Like you don't understand. And if you don't let them buy this coverage, you're actually in violation of the terms of your mortgage, and they could pull your home and repossess your home as well. So again, folks, take note of that. If you're dealing with those situations, don't assume just because your mortgage company found coverage that you're properly protected, because I guarantee you Joe will agree to this. He's shaking his head. Absolutely not. So go ahead. So I wanted to get that out. And then, so you had some numbers for me. We want to share what's been going on in especially the homeowner side of things, and not just Florida. The show hopefully has more than Florida listeners.
Fingers crossed.
Yeah, maybe one or two people in Delaware might care. Is there's been inflation is the word, right? It's the word of 2022. And so inflation has had a lot of impacts. I shared with you leading into this past hurricane, the challenges we had here with rate increases. But let's talk more about, let's give the listeners some statistics of what's behind these rate increases, of why are they suddenly seeing 20 to 40% increases without a claim, without any storms in their area. Like what's going on there and why? Because I know you had some numbers to share.
Yeah, definitely. And we'll start on the auto side, and then we'll move over to the property side of things. And I'm going to I'll try and summarize some of this for y'all, so we're not beating a dead horse and reading through a whole paragraph. But what I always say, especially when I'm talking to clients, man, is that, hey, a bumper doesn't cost $500 anymore, right? And so I'll go through and I'll share some of these numbers with y'all. And these are national averages, so they can't apply to you. It's not based off of said state, yada, yada. But I'm just going to go through here and read this for y'all real quick. So this is auto-related trends, supply chain issues, and more frequent and severe car accidents. An ongoing shortage of microchips and other critical parts like wiring harnesses, plastics, and glass is making it more costly to repair or replace a vehicle after an accident, obviously, right? That's the thing that people can actually understand and they resonate with. So automakers recently reported that as of August, this is coming from August of 2021, right? So we're pushing just a year ago. August 2020, U.S. dealers had fewer than 1 million new cars on their lots, 72% less than they did in August of 2019. And that scarcity is only revving up cost. Between October of 2020 and October of 2021, new car prices rose 10.6%, the sharpest 12-month jump since 1975. While here's the crazy one. While used car prices skyrocketed nearly 32%, right? Now going to the accident part of it. So at the same time, accidents have become more frequent and severe in the past year, increasing the number and cost of.
So hold on.
Okay.
Let me jump in. Let's give a so what there. Okay. Because the numbers, let's translate what we're talking about. If your used car values went up 30%, 32%. So basically what was happening, and this happened to us a few months ago, we had to go find a car and we were buying used. And the used cars were literally at 90%. As a 3-year-old car, they were 90% of the retail value. And I'm like, what is going on?
I knew.
Okay.
Right.
So, well, but like you just said, there is no new.
True. Yep.
So there's a dealer down here that said to us, again, this is February, March of this year. He said, we normally have 600 cars on the lot, new. It's one of the biggest Lexus dealerships in the country. He says, we have 10.
Wow.
10.
Wow. That's
like 1.5%. Right. Okay. And they had a fair amount of used cars, but certainly not a ton. Mm-hmm. And then I'm looking at them and he's showing me the tissue. He's showing me like, this is what the car sold for. And it's 90% that I'm, I like buying premium luxury used cars and you pay 40%, 30% off of retail, when it came out, and I pay 60 cents on a dollar and I'll buy it 3 years old. Right. And I'll use it for X amount. Well, so the so what in here, what Joe's saying is if my $50,000 used car is still worth $50,000 3 years later, the insurance company and the depreciation never took place. Whereas when the second you leave the lot, you normally would experience a 30% decline and your car got smashed. Well, they're only looking to pay 70 cents on the dollar. That's why they sell what's called gap insurance, is to cover the gap for that depreciation, especially when you lease, right? And so people don't understand that correlation. So if my used car is worth 30% more than it should have been, well, then doesn't my insurance have to go up 30%? Because if somebody totals my car, well, I got to go buy another $50,000 car, not a $35,000 car, because the $35,000 car is costing 50 grand to replace, which is bass backwards in the way things have been. And so our brains haven't caught up with that logic. They're just seeing rate increases. And I'm like, yeah, but go sell your used car. Like you're going to get $5 grand more than you paid for it now. Like it's insane what happened. Now it's settling down a little
Well, and
bit
that's
with
and
high
that's
interest
that's
rates.
this next piece that really changes it, because a lot of we'll get stuck on the fact of just the inflation and the building material, whatever the cost of material, right, and the labor shortage, yada yada. Which we'll cover some of that on the property side. Here is the number one thing, which, and I know you see it, we see it every day: distracted driving, right, and people just not paying attention on the road. Y'all, the most dangerous thing we do statistically every single day is get behind that wheel. Not to say that you're a bad driver or I'm a bad driver, but there's a lot of bad drivers out there. There's a lot of distracted drivers out there. And it drives me up a wall. Every time I'm on the road, I see at least 3 to 4 just staring at their phones, not even paying attention. And so here is a crazy number. Increasing blah, blah, blah. Okay. In the first 6 months of just the first 6 months of 2021, right? And so think about it. Carriers are analyzing these numbers. That's why we're now seeing the impact in 2022, because they need to recoup losses, right? But again, it's the liability piece, not just the property damage piece. In the first 6 months of 2021, car accident fatalities increased 16% from the previous year. So just in the first 6 months of 2021, they bumped up, and these are fatalities, y'all. These aren't just, hey, I broke my arm, here's $5,000, $10,000. I mean, you're talking people are maxing out policy limits and probably still being pursued in the act of a lawsuit after the fact, because it's a fatality. The average lawsuit in America right now for a fatality is $1 million, at least, right? And so when you factor that into how these auto insurance companies are determining rates, property damage, okay. Inflation, okay, that I think we can understand. It makes sense because a lot of us are feeling that just in our day to day, whether you're in insurance or not. But man, the fatality, 16% bump in half the time of the whole of 2020, right? And that to me, and that's the sad part, is people put your phones down, just focus on the road. I mean, that many people dying, driving up that much, and it's just that is a really sad number to me, because I'm like, and I'm sure it's only gotten worse, in the years to come. So.
And again, let's correlate that, because in the insurance, it's not just the cost of the car.
Correct.
There's now the liability side where bigger checks are being written, because if I smash into, God forbid, I smash into a family and damage them, kill them, permanently, institutionalize them, I'm going to get sued. And so my insurance company, based upon the amount of coverage I have, is going to cover me up to a certain point, and then they're going to come after Bruce, right? And my personal assets. And we're not going to get into umbrella, but that's why people have umbrellas. That's why people have trusts. They protect their assets from that. But God forbid, I'm that kid I'm a 20-year-old that's looking at my cell phone, and I plow through an intersection and hit an old couple that stopped at the red light. So somebody's writing a check for a lot of money. Those PI attorneys are coming after you.
And you don't have that money, they'll garnish your wages for however long they need to.
Absolutely. Again, people don't really, give me state minimum. Okay, $25,000, $50,000, and you're on the hook for $3 million. Like, what are you going to do now? And you'll have to pay it. Like Joe said, you have to pay it. So let's do this. Let's cover a little bit on the homeowners, and then we're gonna break. We're gonna do a part 2. So just for recording purposes, and then we'll get into commercials. So we're going to make this 2 segments, all right, just because of the timing of it. We want to keep the window where we can. So we talked about, auto. So let's do a sense of where we are with the home, and then we'll wrap up today's show, and then we'll do part 2.
Yep, absolutely. So I'll cruise through this with y'all It's staggering numbers. It's pretty crazy. So in the first year of the pandemic, lumber prices alone jumped 42%. So just lumber prices alone jumped 42%. Steel mill products rose a staggering 81% in the first 3 quarters of 2021. So you're not even talking the whole year. Just in the first 3 quarters, up 81%. Obviously, higher materials costs naturally lead to more expensive bids on home repairs, new construction, right? That makes sense. Now, here's the other pieces that I don't know if we necessarily hear enough about this, but the home building industry right now has been facing a shortfall of at least 200,000 skilled trade workers, which is obviously driving up the construction-related labor costs. So not just the cost of the actual material, but the labor cost, right? Because now you're losing, you got to pay more, whatever it is, just to get people to show up, whatever that is. And about 60% of surveyed builders report, and again, this is national numbers, report a skilled labor shortage, obviously combined with the high cost of construction materials. This has been making home claims that much more expensive, right? So think about it on the claim side of things. Not only is it costing, 82% bump for steel to just replace the property, the dwelling, to get you back to where you were, but then also just who's going to come do it, right? And you've got over
Right.
you're short 200,000 people. Yeah, it's definitely making an impact.
Well, and you correlate this because you go out to eat with your family, right? We go out to eat, and every restaurant you go to, even 2.5 years into the COVID situation,
right.
everybody has, please be patient, we're understaffed. Please be patient, hiring dishwashers, hiring servers, hiring bartenders. Like, we're down here in vacation seasonal heaven in South Florida, and everybody's has a shortage of staff getting ready for the influx.
Yep.
So all these industries are now struggling with, we saw something like the McDonald's or the Kentucky Fried Chicken was paying $16 an hour.
Wow.
Because they need
People.
staff,
Yep.
right? Or 18, and some of them are $18 an hour. So, meanwhile, I work at Walmart for free, scanning my own bags and my own groceries. Right? Like, wait a minute, something's wrong here, but they got it figured out. We don't need a labor shortage. We're just going to go automate it, right? And that's what's happening. You walk into McDonald's and they have a big kiosk because they don't have staff anymore to take your order. Like, it's a computer. So they're trying to figure it out, but you can't automate your home repair. You can't automate your roof repair. You can't automate your rebuild. So we've got these factors. You got high prices of supplies, right? Shortages, high prices of supplies. Now, remember, folks, if your house is worth $1 million, if your house is worth $200,000, that includes your land. Your land has a premium depending on where you live. If you're on the beach, you're on a lake, right? You're in a cul-de-sac. So there's a value to the land. So you're not replacing that. The question, what Joe's talking about, is the rebuild for the physical building itself.
Correct.
And so if I have a house worth $1 million and the rebuild is $700,000, well, now that's really what I need for cost of replacing. Now, if it costs $800,000 for the supplies and $200,000 because of increased labor, well, all of a sudden I need $1 million when I was only insured for $700,000, and so the insurance company's got to raise their rates.
And that's and I think this is, before we break too, this is a great. I wouldn't call it a warning. This is just a heads up. If you're because your property taxes have gone up for the past 2 years, right? The house that I'm in now, when I first got into the neighborhood, we were at $350,000. Now it's being appraised at like over $800,000, right? So now keep this in mind.
Wow.
Have you reviewed your home insurance and have you checked your coverage limits? If your coverage is still the same as it was 2 to 3 years ago, you need to make that call and you need to increase those limits, because your coverage is not adjusting with the market, right? And so make sure y'all, I hope anybody listening to this, if you haven't looked at that, if you haven't reviewed it, if you hadn't had your agent call, right, make sure you're doing that. Be proactive in that, because the last thing, again, knock on wood, God forbid, something happens. It's like, well, I had adequate coverage. Well, yeah, but that was when you signed up, right? And obviously a lot has changed in the past, even just in the past year in 2022, let alone 2021 and 2020. So
100%. I can't tell you. I agree with you. 100% is we see people's policies come in. Hey, I'm getting a higher rate. Can you shop this for me? Well, send me your declaration pages. Send me your outline of coverage, your summary of benefits. And the first thing you look at is like, well, it's $500,000, but Zillow says your house is worth 1.2. So somebody's off on the numbers, right? So you wonder why you're getting a rate increase. Well, the insurance company knows the neighborhood went up. That's why your premiums went up. So what are you going to shop? Well, nobody's going to come in and you'd be making a massive mistake just keeping $500,000 of coverage if you need 1.2.
These are not the times to be cheap. And I hate to say it. I know that, hey, if you're balling on a budget, I get it. But wherever you can, try to squeeze some of that extra coverage in there, because really, this whole, I don't really foresee it changing here. Now it's starting to try to rebound, right? But still, you've got to think, especially for Florida residents, I pray for them. Your rates all next year are going to, you just lost millions, if not billions of dollars down there, insurance company wise.
We're expecting 30 to 40% increases from here because of
one storm.
And we've been telling clients, one storm. And what happens if we get a storm next year
Right.
and the year after? Like, it's just, and less people are going to be covered. Less insurance companies want the risk. Yep. Again, people trying to educate people at the show and all these so whats is, if Joe and I are insurance companies, we can only take on so much exposure. And then we hit our limits because we can't take on 20 billion when we only have 10 billion of reserves. We got to stop at 10. So when 5 billion of homes come on the market as being uninsured because my competitor just went out of business, I don't have the ability to take it on, or right. And then I got to correlate my premiums to make sure that I've got my coffers strong enough to back it up. Because again, people, you have to understand the insurance industry. Most people understand what FDIC insurance is, right? It's insurance. And that has to do with the banks, and the banks going out of business, where the banks pay for insurance to the government in case they go under. Okay. Well, the insurance industry doesn't have an FDIC direct program, but it is in and of itself that regulated that they have to have a certain amount of dollars in reserve relative to the risks they're taking on. And so that's the math. And you as a consumer want and must have that, because the last thing you want to be told when Uncle Joe died, we didn't have enough in reserves to pay that life insurance. Oh, wait a minute. You can't. And guess what? It's never happened. I'm doing this longer than you're around. And I say that with love. But my point is, we've never had a life insurance company default. We've never had an annuity company default. Because the system is designed with reserves. And then guess what? The competitors will step in and absorb that book of business and back it up as well. And then if need be, the regulators and a FEMA and other things will come into play as well. So there are layers in there that people want to understand. All right. Let me bring this to a close for session 1. I'm speaking with Joe Kampert, VP of Redwood Agency Group. We've been talking about the state of the union with auto and home and what's been driving prices and what you can expect moving forward. This is session 1 of Ask the Planman episode with Joe Kampert. Joe, real quick, how can people get a hold of you if they want to speak to you more, either about opportunities or potential doing business with you at Redwood for their insurances? How can we get a hold of you? We're going to put it in the show notes, but give a quick shout out there.
Yeah, absolutely. So you guys, you can shoot me an email, joek@redwoodagencygroup.com. No, it's a little long, sounded better than rag.com. So again, joek@redwoodagencygroup.com. You can go to redwoodagencygroup.com. So the website, there's a little contact us button. That, or if you are on Facebook, feel free to add me. I am very, very prominent. Like, I spend a lot of time in Facebook. We do a lot of cool things there just within the groups and just personal page. So if you guys can find, again, Joe Kampert, Kampert with a K, and you guys can definitely go add me there, message me, whatever's easiest for you.
All right, terrific. So let me bring it to a close for now. You can contact us at asktheplanman.com. Bruce at asktheplanman is my email. Please like, subscribe, hit up Joe, share this with your friends. We got YouTube. We got all the podcast channels. Visit our website, Ask the Planman. Give me a call. I'll pay for it, 1-844-PLANMAN. Stay tuned next week for part 2. We're going to pick up the conversation with Joe Kampert. Joe, thank you so much for being with us today. And folks, always remember, when you need some advice, always get it right. Come Ask the Planman. I'm your host, Bruce Weinstein. Until next time, make sure you keep planning. We'll see you soon.